Non-traded REITs and why you should avoid these investment products like Ebola. Now, non-traded simply means that it's not sold on the stock market. If you go to Yahoo Finance and it can't be found, it's not on there, it's private equity, it's non-traded, avoid it. Also, don't be fooled into thinking that it's a publicly traded corporation just because you're offered shares of stock. Again, the test is whether it has a ticker symbol and it can be searched on Yahoo Finance. Now, non-traded REITs are not even sold by the big brokerage firms. They know that these are crap financial products. The people who push these are independent advisors, independent brokerage firms, small-time second and third-tier brokerage firms. And that actually, in and of itself, is a problem because oftentimes these small firms, small advisors, they don't maintain enough insurance or capital to compensate clients who may sue them for making inappropriate recommendations to buy these REITs. Now, in 2012, they did a study and determined that 71% of non-traded REITs underperformed their benchmarks. And most non-traded REITs underperformed by about 1.4% per year. So multiply that for every year for 10 years and you're losing out on perhaps about 12.5%. So if you instead simply bought a real estate index fund ETF like RWR, you would not only have done better, but like any ETF, retain your liquidity, meaning you can sell at any time for any reason, and that's critical. Now, some non-traded REITs actually have redemption policies, and they'll use this as a selling point. They'll say, hey, don't worry that this isn't a publicly traded corporation. You can sell it at any time and we'll give you back your money. The problem is that a lot of these REITs are suspending their redemption policies after you give them your money and it's too late. Non-traded REITs are all too often just full of surprises. For example, sometimes that high interest payment rate that they lured you in with gets reduced or drastically reduced. They change the rules of the game in the middle of the game. And you can almost predict this happening when you understand how these REITs work. Usually they're allowed to make interest payments to investors from money that's coming in from new investors. And then, once they stop raising investment money, the distribution yields plummet like clockwork. So all of a sudden, that 8% return that enticed you is now, it might be down to 1%, and you're stuck with it for years to come, wishing that you had instead just invested in an ETF. And with an ETF, you know how much it's worth at all times. With non-traded REITs, you're left in the dark until the very end, and oftentimes that's when you find out that, lo and behold, the final share value of your principal investment has dropped 30%, as was the case with Strategic Realty Trust, or dropped 53%, as was the case with a non-traded REIT called Behringer Harvard REIT 1. You hear these stories all the time, but the brokers who sell these things, they keep tight-lipped about these stories. And it's sad because these crap investments are solicited and pushed on investors under the deceptive headline of not tied to stock market risk. But just because a real estate investment isn't sold on the stock market doesn't mean that it isn't affected by the stock market. Both are tied to the economy. When the economy is bad, stocks go down, people have less money to spend on real estate, businesses close, real estate space goes vacant, renters demand lower rent, and real estate property prices decline and can even crash. Also, the fact that non-traded REITs are not publicly traded is actually the problem, not the selling point. Because with an investment that is not publicly traded, you never know if you are buying or selling at a fair market value price. With real estate, in the absence of an actual independent property appraisal, you don't know what it's worth. And ultimately, it isn't until you actually sell real estate property that you find out what it's actually worth. And typically about 8 to 10% of your initial investment gets shaved off the top to pay for Mr. Broker's commission. That's right, with non-traded REITs, your broker's high commission is subtracted from your investment value. Also, the managers who run these non-traded REITs typically skim off about 2% per year in management fees. So now you know why these products are pushed so hard, such as on paid radio shows. Now, one thing to watch out for is sometimes people are led to believe that a non-traded REIT is somehow publicly traded on a stock exchange. And I actually heard on a paid infomercial that ran on a local radio station, which that's a tip-off right there, because nobody advertises publicly traded real estate stocks or ETFs on the radio. But so this infomercial, first of all, had the appearance of a regular radio show, like it was part of the weekly programming. And so they described this non-traded REIT that they were pushing on people as a publicly non-listed REIT, which requires governmental permitting and audited financial statements. The way they phrased it, it almost sounds like it's traded on the stock market or something, but people fall for these pitches, and the problem is investors are always committing the cardinal sin of what's known as chasing yield. They're fed up with earning 1% with CDs, they're afraid of the stock market because they think it's risky, and the whole while they're ignorant of diversification into bonds and how bonds protect against stock market volatility, and they're ignorant of how you can further reduce stock risk by investing in consumer staples index ETFs or utility stock index ETFs. They get mesmerized by the high annual income rate of these non-traded REITs. You know, it might be 8%, 9%, or 10%, but if it sounds too good to be true, it is. The higher the yield, the greater the risk of loss of principal, broken promises, etc. It's that simple. And if and when they don't give you back 100% of your original investment amount, your return on investment will wind up being less than that income rate. You know, the silly thing is investors will say, I can't live on just earning the 2% that my stock and bond index funds pay. Well, just sell off a freaking portion of your principal that's been growing and compounding. So simple. You should never, ever lock your money in prison in any illiquid investment product. Anyone who tries to tell you otherwise is trying to sell you a high commission product like a non-traded REIT.